Hey everybody, good to be with you today. Time for Advanced Option Strategies. My name is Brent Moores and I do this each week at this time. And today I want to talk about some strategies where, hey, the market's made a good run down after a big run up. And what if you don't think it's going to be running one way or the other significantly? Well, what if we're looking at a stock that maybe isn't as trending as hard? That's what I want to talk about today. I want to talk about a couple potential type trades. And to help me out is Barb Armstrong, who's helping me out in the chat. Appreciate Barb. Make sure you check out some of her fine webcasts throughout the week, including a Getting Started with Technical Analysis, I believe, webcast by Barb. And also follow her and me on X at BrentMooreCS, at Barb Armstrong CS. Let's go through some disclosures here before we get too far into this, and then I'll go into some more detail. And the options do carry a high level of risk and are not suitable for all investors. Information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money application is for educational purposes only. Will you be using the Thinkorswim software today? If you use Thinkorswim Web, that's fine. But it just looks different, and that's okay. Just want to be clear what we're using here. All investing involves risk, including risk of loss. And there's no guarantee that an execution of a stop order is going to be at or near the stop price. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. There you go. Let's head on over to the Thinkorswim platform. And let's just kind of look at the market. This is the S&P 500. We had, obviously 2023 was a big year. And then we had a period in there, and going back to early, they kind of call that the Trump bounce there, right? The rally right after the election. Well, we kind of went up and we kind of lost pretty much all of it. And the last few days, we've actually had a pretty good rally again on that. So I don't know, generally we've had this upward trend, but some question marks, a lot of questions about the market valuations. And so what if you are a little bit more on the neutral area? What could you do? Well, we're going to talk about that here today. I see a lot of familiar names here in the chat, and I appreciate you guys all. Whether I know you or not, whether I've met you or not, that's great. I was able to meet a couple of our friends out there in Houston a few weeks ago, and I know Barb's going to be out at a workshop before too long. You can go out and meet Barb. Barb, maybe you can remind us where you're going to that workshop. I can't remember where that is. Maybe Seattle? I'm not sure. But in any case, this class where we're going to go through some strategies, I'm kind of assuming you know the basics of options. If you don't, also check out our Getting Started with Options class. That's noon on Tuesdays. There, noon on Tuesdays. Getting Started with Options. When I quote a time, I'm quoting Eastern time. But they're recorded, just like this class is recorded. If you want to go back to last week, I'm going to be showing you some stocks today. And a lot of times people will say, how did you find those stocks? Well, I try and explain that, but also last week I showed you 4 different ways of finding potential trades there. So you could check that out. You're absolutely right. Ricebird was one of those that I met out there in Houston. So individual stocks may have a more bullish or bearish posture as well. But regardless, when we think about technical analysis, and remember, technical analysis may not be the sole means of investment research. And if you've seen me before, you've seen me do this before. Trend, support and resistance, and then momentum or other indicators will be kind of third on the list. What I'm going to be talking about is what if we don't have, or you don't anticipate a super strong trend? We'll still probably try and look for support and resistance levels, because very often, if we do have a stronger trend, we may do something like a long call or a long put. By the way, I teach a class on long calls and long puts on Tuesdays at 1 o'clock Eastern time, if you want to check that out. Those are generally going to be, we're going to be looking at a lot of more trending stocks in that class there. Okay. Atlanta is where Barb is going to be. So if you're in the Atlanta area, I've never been to Atlanta. I'd love to go sometime. Check it out. So we're going to pay attention to support and resistance is going to probably be the main factor there. And we're going to look at the trend, but we don't want a super strong trend probably. So let's look at some examples of stocks that are more neutral. Then I want to talk about using iron condors and unbalanced iron condors today. Iron condors and unbalanced iron condors. So when I talk about an iron condor, just as a review for you, if you have a stock at a certain price and you think, well, I think that stock is likely going to go neutral-ish. Now, obviously, it's not going to go flat line. It may go up and down or something like that, but generally kind of this neutral pattern. If that's what our expectation is, we may sell a call spread, short call, long call, above where we expect the stock to be. Okay, we think the stock is going to kind of be in this zone. We may do that. And if we think the stock is going to stay above, we may sell a put spread below it. And so that's going to be a short put and a long put. Okay, so the long call, short call is a short call vertical. These two together make what we'd consider a short call vertical. A short put, it's supposed to be an L there, and a long put make a short put vertical. And then if you do all this together, that's an iron condor. Okay, and so generally we're going to call that a neutral type trade. You can, by the way, skew that a little bit more bullish or a little more bearish just on the strike prices you pick. If you pick slightly higher call prices and higher put prices, you shift this whole thing up a little bit, right? You shift that up a little bit, and then we're a little bit more bullish or bearish. But if you're strongly trending, it's probably not the stock or the trade of choice for you. We can also, there's other ways to skew it too, other than just adjusting strike prices. You can adjust the number of contracts that you're using, okay? You can also adjust the width. Traditionally on an iron condor, if you're, say, selling a call spread, say we sell a call vertical with, say, $2 difference between our, I'll just make up some strikes here. Let's say we have a 56 and $58 call spread, then traditionally on the put spread for a normal kind of iron condor, we'd look for a $2 wide put spread. And I'll just make up some numbers again. We'll say a 50 and a 48. So there's two ways we're going to look at unbalancing them. One is we can just change we could say, oh, look, on this side, I'm going to make it $3 wide, 59.56, and we'll leave this as $2 wide. And that is effectively going to make it, we're going to skew it a little bit more to the bearish side if we do that. Okay, a little bit more bearish skew. Or what we could do is we could say, oh, instead, we'll keep those strikes that way, but I'm going to do 2 contracts of these and only 1 contract of the other. Okay, so those are all ways of kind of unbalancing that iron condor. Let's look at some real life examples here. Of course, these are, when I say examples, they are examples. Okay, they're not recommendations, they are examples. I'm going to pull up a stock that everybody knows. A lot of you have it in your pocket right now. AAPL, Apple, okay? So let's say we have Apple, and Apple has been, wow, I mean, this has been moving pretty strongly, and I'm not actually going to use this trade here because we have earnings coming out. I'm going to mostly avoid earnings today. I have done sessions in the past where we've specifically targeted earnings trades. Today, I'm going to specifically avoid earnings trades, but there are some in the past, you can look through the playlist if you're interested in those, where we specifically target earnings trades. But in this watch list, I'm using the S&P 100. The ones that have the blue circle and the red circle, they have earnings coming up. Okay, so Apple has earnings coming up, but I want to kind of use this as an example. We have a pretty strong move down, and so on the surface, we'd say, oh, that's trending down. That would not be available for an iron condor. However, look at this, all this trading that went in this area here, in this zone. So very often when a stock is going into more of a congested area, then we'd expect it to hold up there. Another way to do that is to use a study called the volume profile. Are you guys familiar with the volume profile? Basically, each day, there's a certain amount of volume that's traded. And that's typically when we're looking at volume, you may look at a volume chart where there's volume at the bottom of the chart. I don't have it up right now, but you can see how much volume is on each day. But what if we kind of flip that around and say, not on each day, but for each price, how much is volume is there for each given price? That's what this volume profile is right here. So here's kind of our zero line, and you can see it spikes here. This is where most of the volume has been on this. Okay, that's where most of the trading has been there. And the theory with the volume profile, and you don't have to use it, I'm not like trying to make a sales pitch or anything for you to use volume profile, but you may find it helpful to see, look, this is an area where it seems to be comfortable trading at these prices here. Therefore, the assumption may be, I think the stock is likely to stay in this area. Now, of course, it doesn't always stay in that area. Look, we had a kind of a bump there and a bump there. It didn't stay in those areas. It's not necessarily going to stay in that area, but that's one way to look at it. So if you're trying to look at these and you're trying to decide, oh, where's this going to go? You may consider a volume profile to help you out. Now, let's look at this. Let me give you a contrasting one. If I look at AMD, look at what happened with AMD. Right now, we've trended down on AMD. Again, we have earnings coming up on this. We're trending out. We're in this kind of uncharted territory, and the areas of the higher trading up here are areas that are kind of distant from where we're at right now. So either the trend continues, or maybe we revert back up to this area, but it doesn't seem like very neutral. This would probably not be much of a candidate for an iron condor trade there. Now, let me point out two things in the chat. One, there's a survey link. We appreciate your feedback on the survey, so thank you. Okay. Number two, Eric said, sometimes I leg into an iron condor. Yeah, absolutely. When I say you do that short call vertical and that short put vertical, you don't have to get it into both sides at the same time. Let's look at some other trades here that I was just kind of looking at. Well, you can just kind of go down the list. Apple, AbbVie. What do you think? More neutral? Maybe. It's not really much of a trend right now. It's been going more sideways. You can see that volume profile if you're going to use that volume profile there and look at it right there. That would be a potential trade for an iron condor. Again, we have earnings here on this. We have earnings on that. Let's look at some others. Here's ACN. No earnings, it looks like, on ACN. That'd be a possibility there. Okay. Well, I guess we have earnings. Where's earnings? Yeah, no earnings in March. You could find a strike price before then. Sure, no problem. So that's a possibility. ACN there, more sideways. I just want to give you some examples here on what you may consider looking at. Okay, here's AIG. We're right in the area of the point of control. Now that's a new term. The point of control is this right here on the volume profile. It shows where the most volume has been. It also gives you this zone. See this zone here from there to there? That's where I think that incorporates 70%, if I'm not mistaken, of the volume on the chart. Now, if I change the length of the chart, this is a 9-month chart. If I change the length of the chart, the volume profile is going to change a little bit because it's inclusive of more or less volume that we're going to look at there. But here's a trade that it's really not trending much, is it? It does seem to be kind of on the volatile end of things there. So let's do this. Let's go and let's look at some stocks that do not have earnings coming up. I'm going to drop off that volume profile here for a second. I'm just going to go to a plain chart because I just want to look at this. Here's Broadcom, AVGO. We were kind of sideways, maybe slightly bullish. Then we jumped up on earnings. So we're past earnings. Now, if we had earnings in early December-ish, I don't know what the exact date was, that's kind of blipping on me, about the 12th or so, then I would expect earnings to be again on, let's see, January, February, about March 12th, something like that, okay? So we'll just do some trades before that. But my assumption is this. My assumption is we have some resistance kind of up in here and that we have some support down in there. That's where the area we're going to target here on this. So I'm going to look to do a short call vertical up here, a short put vertical down here. Where exactly? Well, we're going to do two things here. Number one, I'm going to look at, from a technical standpoint, around 220 is our support level. I'm also going to look up here and I'm going to say, oh, kind of up in, what's that? That's 240 there, about 245. 245 is about our resistance level. But I'm going to go beyond that because what I want to do is I want to look at probabilities as well. Now, probabilities are not certainties, but probabilities can give us kind of a statistical measure of the odds of a stock going above or below a certain price. And the way I'm going to do that is I'm going to go to the trade tab. I'm going to go out. I'm just going to go to monthly options here. We'll go to February 21st, 35 days out. Okay. And I'm going to use a delta column. Now you can use a probability in the money column as well. Okay. They're going to give you, similar, not exactly the same numbers here. And the way to think about it is this. Although delta technically is telling you how much an option is going to move in relationship to an underlying move in the stock price, a $1 move in the stock price, we can also use it as a kind of an approximation, if you will, of probabilities there. Okay? So here we go. So I'm going to say, I want this to be, I'm going to look for probabilities that are around the 20%-ish level here. So I'm going to look, here's 23. It's a little high. I could go to 18. So there's nothing right at 20. But I'm going to look here for a short call. Okay. Similarly, on the puts, I'm going to do a similar thing on the puts. I'll go down to about a 20 delta. The closest we got is this 22 delta. And I'm going to look about 220 for my short put. So let's do this. Okay. Let me get rid of my drawing tool. Okay, so I'm going to sell the 260 because I'm looking at that delta. Remember, I'm looking for relatively close to that delta. Now, if 260 were below my resistance level, I would not want to do this trade. But I wrote down that resistance level and it was around the 245 area. So it's actually above that. So that gives me a little extra wiggle room there. So I'm going to sell that. I'm going to hold down my control key and I'm going to buy the next one up, which is the 265. I'm holding down the control key so that I get them both in there. I'm going to go to my puts. And we said our put support was around the 220 level. And that's right where our 22 delta is. So I'm going to sell this one by clicking on that bid price. I'm going to hold down the control key again. And I'm going to buy the 215. Hold down the control key. There's my iron condor right there. Okay. Notice this is not unbalanced. We'll look at unbalanced in a minute, but this one right here is strict by the book, normal iron condor, $5 difference between my call prices, $5 difference between my put prices. Let me just shrink that down. So this is giving me a 186 credit. Let me just click on confirm and send. I'm not going to send it quite yet here, but let's look at this. All right. Now, what's my return on risk here? So 186 is my max loss. I'm going to divide that by 186 is my max profit. I'm going to divide that by my max gain. My max profit, I'm going to divide by my max loss, which is 314. And that gives me about a 59% return on risk, which is fairly typical for these kind of trades. Now, I am risking more than I potentially am going to make on this trade. So let me go back here. I'm also going to put in some exits on this in case it goes against me. Now, if I want to, I can right-click on this and click on Analyze Trade. Let's look at AVGO. Let's go to Risk Profile. Here we go. This is what it looks like. Okay. This is what the trade looks like. And let's see, today is the 17th. Yep, I know that. Today's the 17th. My expiration date is the 21st. So I'm going to go up here and go to February. I'm going to go one day after that and kind of give here. So this kind of gives us our probabilities here. Okay, this kind of gives us our probabilities. Now, remember, we are selling a call spread. We sell a call vertical. We're selling a put vertical. Okay? There was a question in the chat. How does this compare to a strangle? Well, compared to a short strangle, okay, let's specify short strangle, not long strangle. Compared to a short strangle, we have protection on this. In other words, we're buying a call and we're buying a put in addition to the calls and puts that we're selling to limit our loss. So here's our here's our max loss that we see. Here's our max loss that we see here, okay? So, so there we go. Now, and here's our max gain. And you can see the distance between break even, which is right here, and our max gain is less than the distance between our break even and our max loss. That means we stand to lose more than we gain. Okay. Now, Chris said you can only lose on one side unless you leg out of. Yes, correct. At any given time, I can only be out on one side or the other. If the stock goes way up and it goes up here, and bummer, because that's not what we want. We want the stock to stay in our central zone there. But look, we're fine on the put side of things, right? This is a short put vertical on that side. Here's a short call vertical on this side. So that's one of the advantages of these. What's our probability? Our probability is, well, this plus this is, what about 65, 66%, something like that, percent chance of being within our break-even points. Now, what if it slips out? It may not stay in there. What we don't want to do, the goal here is to not take our max loss. Notice our max loss at expiration is different than our max loss before expiration. That's our max loss today, or I shouldn't say max loss. This is our loss, anticipated loss. These are all estimations, right? This is an anticipated loss. If the stock were to go up to, say, 275 right here today, yeah, we'd be losing, but we're a long ways from our max loss. Okay? So if the stock, so Ricebird said, if the stock stays between this 213 level and this 261 level, then that at expiration, sorry. Wait a second. I need to set my slices. I didn't set my slices. Okay. Set slices to break even. I did not do that. Break even. Okay, there we go. So our probabilities, I said 66% probability, it's more like 61% probability. And so to your question there, Ricebird, if the stock stays between 218.17 and 261.82, okay, then let me just jot this down real quick. Actually, I'm not. I'll just add that to the chart. Then that's great. That's our break even at expiration. Now, what if the stock moves down to 220 right now, today? Am I going to be making money? No, I'll be losing some money there. But that money I'm losing is much less than a max loss on that, probably, right? Or I don't know exactly what that number is. It's around minus 80 or something like that. So we're going to put in exits to get out, okay? And you can just put them in. You can put them in at a support level, resistance level. You can put them in at your break-even levels as well. So here's what I'm going to do. I'm going to go to this chart. I'm going to set slices to charts. And there's our break-evens on our chart right there. Automatically does it for us, okay? So I'm going to say if we break down below this guy, which we said was 218, we're going to exit. If we break above, I'm going to say up here, we'll go to this high level here, 250. We're going to exit on that trade. So how do we do that? We go to our trade. I'm going to change this from single order to a sequential order. I'm going to right click on this. I'm going to create an opposite order. This is the one that we're entering to trade with, okay? We're selling to enter. This is the one to buy it back. That's why it's in green. And what I'm going to do is I'm going to click on market. I'm going to click on good till canceled. I'm going to go to the gear. I'm going to click on that gear. And I'm going to say, I want to get out if AVGO marks less than or equal to, and this is why I wrote it down, 218, or if it marks greater than or equal to 250. Now, someone earlier mentioned about legging in. You can certainly leg out of this. I may not stick with this necessarily and exit as the whole shebang here. What I may do is I may decide to get out of one spread and then the other. All right? Okay. So, and there we go. So what's our max loss on this? Frankie asked a question earlier, and looks like it may have been answered in the chat, but it's a good question. Why isn't our max loss greater than $5? Because there's a $5 spread here. Remember, we're bringing in a premium here. So our max loss is going to be the difference between those $5 minus that initial credit there on that. Okay? All right, let's go back. Let's just submit that guy. Confirm and send. Make sure you read everything. And actually, let me go back and just point this out. Our mid price is 188. It may be a stretch to get filled at 188. I'm just going to knock it down a little bit from there. Okay, see if we can get filled on that. I'm going to confirm and send, and I'm going to put that in a iron condor short vertical area. I'm going to send that, and it's thinking. Okay, it's thinking. We'll see if we fill on that or not. Now, I mentioned earlier that we can skew these a little bit if we want, and we mentioned two ways of skewing your trades. Let's look at these. First of all, let's look at FedEx. Okay, FedEx, FDX. Okay, we all know FDX. This is what I'm going with on this one. I'm saying, look, we've had lower highs, so we've kind of had this. Lately, we've kind of had this sort of channel down here on that. But not only do we have an area that we traded in quite a bit more, but we also have a support level that we've hit. boom, boom, boom. So what I'm saying is the general trend has been down, and that I don't want to ignore that. So I'm going to take a little bit more of a bearish posture on this, but not super bearish. I'm not ready to go out and do a long put on this. What I'm going to do is I'm going to do something that's bearish neutral or neutral bearish kind of deal. Well, how do we do that with an iron condor? Well, here's how one way we can do it is we can just adjust the strike widths on these. So let me give you an example here. If I go to the trade tab and let's see, when is our earnings on this trade? Let's go to analyze. Very funny, Wiley. Analyze earnings and earnings date March 20th. Okay, March 20th. All right. So again, we want to do something before that time, which it's no problem. You can choose what you want here in terms of expirations. I'm not going to go out very far. I'm just going to go out, we'll go out 3 weeks on this. February 7th, okay? Now, I'm going to look here. Again, I'm going to look at my deltas on this. And I'm going to find a delta that kind of makes sense here. And I'm going to find this. This delta is 22, okay? If it had 20, I'd do 20. It just changed to 21. It's not, the last one was 22, was the only reason I'm saying that. I'm going to sell that. I'm going to buy I'm going to hold down my control key and buy the 260. Okay. Now, I'm going to go to the call side. And I'm going to sell similar. I'm going to go, well, we don't have a 20 delta. We have a 17 delta. I'm going to sell that and hold down my control key. But I'm going to skew this to be a little bit more bearish. So instead of going down one strike width, in other words, $5, I'm going to go to the 300 there. And I'm going to hold down my control key. And now let's do this. Let's look at this trade here and see what can you kind of envision before I click on this, what is this going to look like? What is this risk profile graph going to look like? Well, let's take a look. Oop, that's not there. There, okay. Just kind of move this over right here, right? Okay, so notice we have introduced asymmetry into this, right? There's more risk. Risk is the difference between our break even and our loss. There's more risk on the high side. This is the call side. This is our short call vertical side. Here's our short put vertical side. Then there is over here, and our other iron condor just filled on Broadcom. Okay, so there's more risk here. So when I said I'm skewing this bearish, I'm willing to say it's less likely that we're going to go up than we're going down. I'm still going to put exits in here, but let's see how this kind of matches to the chart. Let's put in our break evens. Let me just make sure I got my dates in right here. February 7th. So I'm going to go here to February 8th. I'm going to set my slices to break even. There we go. And I'm going to then, oops, clicked on the wrong thing. I'm then going to set my slices to my charts. Okay, and this was just an extra line I had drawn in there, so let me just remove that drawing. These two horizontal dashed lines represent my break-even points, okay? Now, it's pretty symmetrical, the distance between my break-evens on either side, but there's more risk on the upside here on this. There's more risk on the upside. So that's why I'm saying this is skewing a little bit that way. Now, if I want to shift these down, I can always change strike prices. right? I could always change strike prices. If I want to shift it down further, I could go and I could say, well, instead of 290, 300, I could do 280, 290, if that would make sense. That would probably be a little bit tight on, extreme on that, but, or maybe 285, 295 on that if I wanted to. So I could do 285, 295, and I could go 255, 260. Now let me analyze this trade, see what we got. And I've got the old one in there too. Let me uncheck. Let's see, hold on. Which one's my old one? 290, 290. Okay, this is my old one. Okay, and now if I set my slices to break even, and now if I set my slices to the chart, what we will do is, now you can see we've skewed that. Now there's more room here before we hit break evens on this. So I'm going to look to get out if we get above 287, or, well, we'll say 260, 287 and 260. How do we do that trade? Well, same as I did before. I'm going to make this a first triggers sequential order. I'm going to create an opposite order. I'm going to make this a market order, good till canceled, click on my gear, okay, and I'm going to say if FDX marks less than or equal to 260, we're going to get out. Or if FDX marks greater than or equal to 287, we're going to get out. Save, confirm and send. Make sure you read the order on that. Let me just edit this. Again, I'm going to do this, just try and shrink this down just a little bit to make sure I get in here. I'm going to confirm and send. I'm going to put this in my short verticals iron condors. And there we go. We just entered that and that's filled. Okay, I want to look at one more here and then we'll be out of time here. Okay, so let's do Walmart. Again, another stock. I picked it because we had earnings already on this. We don't have earnings coming up for a little while. December, January, February. Just, well, let's just see when our earnings is real quick here. Earnings on Walmart is the 20th. So I want some expiration before the 20th. So I'll go at least 1 week before that. So I'm going to go to Walmart. Let's go to February 14th is before expiration. And I said there's another way to kind of skew this. Now, in this case, what I'm going to say is, look, we've been going sideways. We're closer to the support level than the resistance level. This recent channel, we may drift up a little bit in that recent channel. Furthermore, the trend before this was up. So I'm going to give this a little bit more of a bullish bias. So how can we skew this to give you some more bullish bias here on this trade? Just a little bit. Now, if I'm super bullish, I'm probably not going to do an iron condor, right? But if I want to make this a little bit more bullish, what can I do? Here's what I can do. I can say, look, I'm going to go out. I'm going to do the same thing I did before. I'll go to my deltas here, and I'm going to go, I'm going to sell 21 delta here on the call. I'll go out, let's see, I'm going to go out too wide here on this, just to give us a little more credit on this. A little more risk, but a little more credit. I'm going to hold down my control key. I'm going to go to my puts. I'm going to go, let me just get some more strikes in here. I'm going to go down to my delta. I'm going to go 88. We'll click on that, control key, and 86, click on that. Okay, so here is my iron condor, but here's what I'm going to do. I'm going to say, I'm going to take a little bit more of a bullish approach on this. Therefore, I'm going to have more contracts on my puts. Now, it's not going to let me change it. It has me change the whole thing at once here. So what I'm going to do is I'm going to change this to custom. And then once I change it to custom, it will let me individually change these contracts. So if I wanted to do 3 of these and 2 of these, let me analyze this trade. Risk profile. There we go. Looks kind of similar, except flipping more bullish than bearish to when we just unbalanced it. So just to recap, there's 2 ways to unbalance it. One is make the one strike price wider than the other strike price. Okay. The other is adjust the number of contracts here on this. And that's a way to do that. Okay. So there's 2 ways to unbalance it. If you're truly neutral on a stock, then you're probably just going to do something that's more symmetrical on this. But if you want to skew it a little more bullish or bearish, those are 2 approaches to that. Okay. Now, make sure you subscribe. How do we manage these? I put in exits on most of these. I haven't on Walmart yet, and I'm not going to right now. Because what I want to do is, in fact, let me go. I'm just going to confirm and send this trade. Okay. We're going to send and send that. Okay. Now, when you're managing these, you'll notice I have a category that I said short verticals, iron condors. Okay. I threw them in there. In these, you can manage your iron condors like verticals. You can get out one side at a time here. Here's AVGO, we just traded. Here's BIIB. Typically, what I'm going to do is I'm going to manage these in our managing an options portfolio class, which occurs on Wednesdays at noon. Okay? Wednesdays at noon. But I didn't teach that class this week, so I wasn't able to manage these. Biogen expires today. I'm just going to let it expire. It's out of the money. We've made money on that, okay? Disney, 7 days till expiration. When I'm within 7 days and I'm not at a max loss, I just want to get out of this and take my wounds. We've lost almost $100 on that Disney trade. I'm going to just get out of that Disney trade here. I'm going to create that closing order and I'm going to confirm and send, and I'm going to get out of that trade because I don't want to lose any more on that Disney trade. Okay. So I want to limit my losses and hopefully cut those short. Google. Well, we've made about $85 on that. We have 7 days till expiration. When I'm within a week of expiration, generally I'm going to get out of these. That's true with iron condors. It's true with unbalanced iron condors. It's also true with these vertical spreads. So I'm going to look to exit that trade as well on that. All right. That's all I have time for today, folks. It is time to wrap it up. It is not too, let me just answer real quick questions here. Is it too late to exit if it gets in the money? No, it's not too late to exit if it hits in the money. Remember, you're not at max loss just because it hits in the money, assuming you're not all the way to expiration. If you get out earlier, and I tried to demonstrate this earlier, if you get out with sufficient time, you're not going to be at max loss. You can certainly, it's not too late to exit. Good question. How do I identify within a sector which stocks can perform well based on the sector relation? Well, I'll tell you what, we have a class on market and sector analysis, 3 o'clock on Wednesdays. Make sure you check that out. I don't have time in what we're doing right now to go through sector rotation right now, but look at the sector as a whole there. There's a watch list for sectors. Double check that. There's a survey link, everybody. Thank you. for joining me today. Thanks for filling out that survey, and we'll see you all same time next week. Bye-bye, everybody.